a question given by a particular student. We'll start solving this, then we'll proceed to underwriting. Okay. If you look at 10 lakh equity shares are issued at a premium of rupees 2 per share, application 5 including premium, allotment rupees 4 and first call rupees 3. 15 lakh applications are received, 3 lakhs were rejected. Okay. Here, if you look at who's this N speaking?
Hello.
Gokul, what do you want? Bank account data are 15 lakhs into how much? 15 lakhs into what is the price that is collected? 5. 15 lakhs into 5 collected. To share capital, we would have collected 75 lakhs. Then there is share application account. Share application account data are 75 lakhs. This is 75 lakhs. Okay. To share capital, we are going to do with the shortcut. To share capital to securities premium. So why securities premium? Because it is collected along with allotment money. Sorry, application money. To bank, that is rejected. To share allotment account, that is surplus in pro rata allotment. To share capital will be maximum we can allot 10 lakh shares into what is the premium 2 rupees included in this. So into 3. Okay, premium will be 10 lakhs into 2. To bank, the money is rejected. And please remember, I'm not teaching you, I'm just revising certain concepts. Okay, I cannot teach 100% of the syllabus. You should have been either a regular student of Bharadwaj or some other academy. Okay, so excess applications, 3 lakh shares are rejected. 3 lakhs into 4, 12 lakhs got rejected. 12 lakhs got rejected. And to share allotment will be the 2 lakhs applications, which is received in excess pro rata, 8 lakhs. If you look at, we collected 15 lakhs applications. Okay, 3 lakhs rejected. Okay, 2 lakhs. Okay, balance will be 12 lakhs. For the 12 lakh applications, we are allotting 10 lakh shares, which means remaining 2 lakhs would have been surplus applications. Remaining 2 lakhs would have been surplus application. That 2 lakhs into 4, 8 lakhs. For allotment money, share allotment account data are, this is how many shares? 10 lakh shares into 4, 40 lakhs. To share capital. And please remember, the securities premium has been already included in application money. Okay. Then bank account data are, calls in arrears account data are, to share allotment. If you look at the allotment money due, out of 40 lakhs, already 8 lakhs has been adjusted. Out of 40 lakhs, already 8 lakhs has been adjusted. So 32 lakhs is the money due. 30 lakhs is the money due. One shareholder holding, okay, who applied for 24,000 shares. If you applied for 24,000 shares, and how many shares will be allotted? Simple. For 12 lakhs applications, we have given 10 lakh shares on pro rata basis. For 24,000 applications, 20,000 shares would have been allotted. Simple. If 32 lakhs is for 10 lakh shares, 32 lakhs is for 10 lakh shares, how much for 20,000 shares? You can work out by shortcut method that we had done in the last question. So simple, cross multiply. This would be 32 lakhs divided by, if this is for 10 lakhs, what is for 2 lakhs? Sorry, what is for 20,000 shares? So balance money would have been collected. The question can be based on how much is the calls in arrears and what is the money collected at the time of allotment. Okay, we can work out by shortcut method also. If 32 lakhs is for 10 lakh shares, what is for 2,000 shares? 6 lakhs 40,000, that is calls in arrears. Balance money is collected. Then share call account debtor to share capital. No share is cancelled now. So this will be 10 lakhs into 3, 30 lakhs. Okay. Bank account debtor calls in arrears. Debtor to share first call, to share call account. Here there is no surplus, it will be 30 lakhs. What will be the amount? 20,000 into 3, 20,000 into 3, 60,000. Balance you would have collected, 29 lakh 40,000 you would have collected. Okay, this is at the time of which one? Calls. Now when shares are cancelled, what is the entry? Share capital account debtor. How much you would have debited? 20,000 into 10. Why? Because the shares are cancelled. Which one? Second entry is not tallying. Why it is not tallying? This is 20,000 into 5, sorry. 30,000 into 5. Okay, 5. These are all 5 rupees. I've taken 4. This is 5 rupees. Yeah, correct. 5 rupees, it would have been 15 lakhs. This is 20,000 into 5. Because of the network issue, no? So even the flow of working gets off. 10 lakhs. So we have to collect 40 lakhs minus 10 lakhs. 40 lakhs minus 10 lakhs. 30 lakhs we have to collect. 30 lakhs we have to collect. This working will be 30 lakhs if it is for 10 lakh shares. What is for 20,000 shares? Yeah. So this is 20,000 into 10, 2 lakhs. 20,000 into 10, 2 lakhs. Because it is fully called up. Will you debit securities premium? Will you debit securities premium? No, because the money has been collected along with application itself. So 2 calls in arrears. 2 calls in arrears will be nothing but this money plus this money. Okay. So 1,20,000 to share forfeiture account. To forfeiture account will be 80,000. This is for 20,000 shares cancelled. Okay. So that is for 20,000 shares which are cancelled. Then if you look at we reissue bank account debtor, we reissue only how many shares? Out of 20,000 shares only 10,000 shares are reissued. 10,000 into 8. 80,000. 10,000 into 8. 80,000 is the bank account. Share forfeiture account for the loss, that is 20,000. The balancing for last 20,000 to share capital. to share capital 10,000 into 10, 1 lakh. The last amount would be how much will be transferred to capital reserve. For 20,000 shares, we created, what is a forfeiture account? What is a forfeiture account? For 20,000 shares, what is a forfeiture account created? 80,000. Okay. So for the shares reissued, proportionately how much? It will be half the amount, 40,000. Okay. So 40,000 is the share forfeiture account. What is the loss? 20,000. And you will transfer to capital reserve. 20,000 rupees you will transfer to capital reserve. This is for this problem. Okay, this is comparatively, whatever we have done, comparatively, this is a very, very small problem for us to work out. The balance in forfeiture account will be, out of 80,000, we utilized only 40,000. Remaining 40,000 will be there in the forfeiture account. Okay. Here, there is no loss of premium and all. The premium was collected along with application money. Yeah, please turn off your videos. Please turn off your videos. Yeah, thank you. This is for issue of shares. Next, we'll proceed with underwriting. Okay. Let's recollect what is underwriting. When a company is making a public issue of, let us assume, 1 lakh shares, okay, there is no guarantee that all 1 lakh shares will be subscribed. We know minimum subscription should be 90%. Minimum subscription should be what? 90%. So in order to avoid this fulfillment of minimum subscription or non-fulfillment of minimum subscription, the company can go for appointing underwriters. For all the listed companies, it is mandatory to appoint underwriters whenever there is a public issue. Whenever there is a public issue, who are these underwriters? They give a guarantee. They give a guarantee. What guarantee? 1 lakh shares will be subscribed by the people. We'll ensure that 1 lakh shares are subscribed by the people. If they are not subscribed, we'll ensure that we'll take up all the shares. We'll ensure that we'll take up all the shares like that. Underwriters give a guarantee. Okay, it's a contract of guarantee. Underwriting is a kind of a contract of guarantee entered between the company which is making a public issue and the third party called as what? Underwriter, where underwriters promise to take up the unsubscribed shares. Let's assume number of shares issued is the same example, 1 lakh shares. Okay, let's assume it is underwritten by A and B. It is underwritten by A and B in the ratio of 3:2. Two underwriters are there. They are undertaking the issue at 2:1 ratio. Shankar Narayanan, please turn off the video. Please turn off the video. So 3:2 ratio. This is the ratio of underwriting. Let's assume public applied for 80,000 shares. Public applied for 80,000 shares. So what is unsubscribed? What is unsubscribed? The 20,000 shares. The 20,000 shares are to be taken up by the underwriters in the 3:2 ratio, which means 12,000 shares underwriter A will take up and 8,000 share underwriter B will take up. For this, they have to pay the money. Company will pay commission to the underwriter. Company will pay the commission to the underwriter, and underwriters has to pay, of course, money for the shares to the company. Okay. Now let me to go for a proper example. Okay. How applications are made? Through underwriters, directly to the company. If underwriting is done, or through underwriters of the shares are applied, that will bear a mark or seal of the underwriter. They are called as marked applications. They are called as what? Marked applications. Applications bearing seal or mark of the underwriter. This will be unmarked applications. Why? Because the applications are made directly to the company. Okay. So what will you do with marked application? It will be directly reduced from underwriter's liability. Unmarked applications, unmarked applications, okay, will be shared in the ratio of underwriting. Like in this example, 3:2 ratio, they will share it. Sir, what is marked application? Applications which are coming through underwriters, It is coming directly through the underwriter's effort. So it will be directly reduced from underwriter's liability. And unmarked applications are directly made to the company. It will be shared in the ratio of underwriting. So let me to give a small problem. Issued 50,000 shares. Subscribed 40,000 shares, including marked forms of A, 20,000 and B, 10,000. There are two underwriters, A and B. Let's assume they are underwriting in the ratio of 3:2. They are underwriting in the ratio of 3:2. Okay, how to calculate the liability of underwriters? Who are the underwriters? A and B. Okay, how many shares are issued? That is also known as gross liability. How many shares are issued? Totally 50,000 shares are issued. This will be shared in which ratio? 3:2 ratio. 3:2 ratio. Which means A should take up 30,000 shares if no share is subscribed, and B should take up 20,000 shares. From the liability, marked forms will be directly deducted. What is a marked forms of A? 20,000. And what is a marked form of B? 10,000. So 30,000 will be directly deducted from underwriter's liability. If you look at how many total applications received, what is the total number of applications received? 40,000. This includes marked forms. Marked forms are there to the extent of 30,000 applications. So unmarked forms are 10,000 shares. Now what will you do with unmarked forms? This unmarked form will be shared in the ratio. In which ratio? 3:2 ratio. So this will be 6,000 for A and 4,000 for B. So if you work out, this will be the net liability. Right? So marked forms are coming through the underwriters. Through the effort of underwriters, it will be directly deducted. It will be directly deducted. Unmarked forms are directly coming to the company. So that will be deducted. And please remember, underwriters are liable only for the unsubscribed shares issued by the company. Unsubscribed shares issued by the company. Okay, so this is the treatment of marked form, unmarked form we revised. Okay, let me go with example 2. This is a kind of partial underwriting. You're going to give the answer first. Let me check the answer next. A Limited issued 1 lakh applications. X and Y underwritten in the ratio of 1:1, equal ratio. 1:1. Okay. I'm adding one more word here, 80% of the issue. The ratio of 1:1. In this, I'm giving two cases. Case 1. Total applications received 60,000 shares. No marked forms. Calculate the liability. This is one of the questions that was tested in MCQ in the past exam. Can you give me the answer? Can you give me the answer for this? Is it 10,000 each? Is it 10,000 each? No. They are not underwriting the whole issue. They are underwriting only what? 80% of the issue. They are underwriting only 80% of the issue, which means they are not giving full guarantee. They are giving only what? 80% guarantee. They are giving only 80% guarantee, which means company's own portion, the company will adjust. So out of the total 1 lakh, X and Y undertake 80%, which means the company should bear 20%. Company should bear what? 20%, which means 20,000 will be taken care by the company. Remaining 80,000 will be shared by the underwriters in 1:1. So 80% is underwritten and 20% should be liability should be borne by the company. Less applications. Totally, how many applications are received? 60,000 applications are received. 60,000 applications are received. Now, the 60,000 applications into 80%. 60,000 applications, okay, into 80%. Otherwise, 20% will be taken care by the company. 12,000, and the remaining will be taken by X and Y. How much it will be? So net liability will be, what is the net liability? 16,000, 16,000 and 8,000. This can be solved by a shortcut method also. In this problem or in this case, you can apply a shortcut method. Issued is 1 lakh. Applied is how much? 60,000. So shortfall is 40,000. Underwriter's liability 80%. 32,000. So X will take 16,000 and Y will take 16,000. This way also you can do it. Equal share. Okay, this is case 1. Case 2. Total applications received 60,000 shares, including marked forms of A 20,000 and B or sorry, X and Y. Don't solve by the same shortcut method. It's not going to be the same. This is a most important case that can be tested in exam. The first two things are going to be same, but other things will be different. Try. Try this. Marked applications, how much? 20,000 for X and 10,000 for Y. Company. Total received is 60,000. Marked forms of X and Y. Marked forms of X and Y, 40,000. So unmarked, okay, 30,000. Unmarked is 30,000. What do you mean by unmarked applications? What do you mean by unmarked applications? Direct applications received by the company. Direct applications received by the company. And please remember, underwriting ratio is 1:1. Underwriting ratio is 1:1. Unmarked applications means direct applications received by the company. So out of 10,000, company's share, company's portion, what is the liability? 20,000 it will take. Okay, once again, what is unmarked application? 30,000. In this 30,000, company will adjust 20,000. Out of the 30,000, see, company has directly received 20,000, they will adjust. Balance, how much is left? See, unmarked should be shared in the ratio, but look at the situation. What is unmarked application? What is the meaning of unmarked application? Direct applications received by the company. So it is from the company's effort. For the company's portion, they will adjust this. Okay. For the company's portion, what is the thing? 20,000, they will adjust this. Balance, how much will be there? 10,000 will be there. The 10,000 will be shared by X 5,000 and Y 5,000. It's a most important case for examination. Otherwise, what is unmarked application? 30,000. Okay. What is the share which is not underwritten? 20%. That is company's own responsibility. So company will adjust that 20,000 because total application minus marked application is unmarked application. Okay. Okay. Now this is not fully underwritten. It is only 80% underwritten. It is only what? 80% underwritten, which means company is liable for 20%. For its own shares, it is taking the responsibility of 20%. That is 20,000. Okay. So let us assume I am the company, you are X and your friend is Y. Okay. We are responsible for 20,000 shares. So unmarked application means a direct application received by us. So in this, we'll adjust our portion. The balance left is how much? The balance left is how much? 10,000. That will be shared by X and Y in the ratio. So if you look at the net liability, 40,000 minus 20,000 minus 5,000. I'll give you another example so that you will understand in a better way. Let's assume you are running the company. Let us assume you are running the company. I am X, the other person is Y. Okay, how we are liable? We are liable only to the extent of 80%, which means 80,000 shares, myself 40, the other person is 40. You, the company, is liable for 20,000 shares. Marked application coming through X and Y. Marked application coming through X and Y, 20,000, 10,000, that can be directly deducted. Now look at unmarked application. Who received it? You, the company, received it. How much? 30,000 applications. Out of total 60,000 minus marked, you will get unmarked application. Now what will you do? This 30,000 applications are directly coming to you. So you will adjust your portion. You will adjust your portion 20,000 shares. Now, what is the surplus left after that? 10,000 more is left. That balance you will allow us to share 5,000, 5,000 like that. So X is liable for 25,000 shares, Y is liable for, 15,000 shares, Y is liable for 25,000 shares. Total liabilities is what? 40,000. Otherwise, this unmarked application for you means the company. Okay. It is a direct reduction. It's a direct reduction. Okay. Otherwise, the 20,000 applications coming directly to the company, that is your effort directly. So that will be first deducted from your own portion. The balance left will be shared amongst underwriters X and Y. This is the most repeated case in the examination. This is one of the most repeated case in the examination. 90% of the time students went wrong. What they used to do is this 30,000, they will share it in 15,000 like that. They will say 5,000, okay, 15,000, then liability 20,000 like that. Commission will be calculated only based on the shares. This one, 40,000, 40,000. 40,000 into the value into 5% like that. This 40,000 into value into 5% like that, it will be calculated. Commission is always calculated on the gross liability, that is number of shares issued, and that is underwritten by underwriters. Firm underwriting. Now let us look at a case where number of shares issued is 1 lakh and public subscribed 1,20,000 shares. Now, how many shares will be given to underwriters? How many shares will be given to underwriters? Nothing. Underwriters will get no shares. Why? All shares are subscribed. All shares are subscribed. Here, underwriters add a clause called as firm underwriting clause. Underwriters add a clause called as which one? Firm underwriting clause, where they tell that let us assume underwriters are A and B. They are undertaking, even if all shares are subscribed, minimum you give me 2,000 shares and for B 3,000 shares like that, which means first underwriters will be getting the shares. Remaining 95,000 shares will be given to the public. Even if the shares are fully subscribed, underwriters are agreeing to take up certain minimum number of shares, that is called as what? Firm underwriting. For this, they have to apply. For the firm underwriting, they have to apply. A will apply 2,000 shares and B will apply what? 3,000 shares. Now, what is the difference between marked applications and this firm underwriting? Simple. It is public applications through underwriters. This is underwriters directly applying on their name. Okay, marked application, I collect the money or I collect the application and forward to the company. Firm underwriting, underwriters are going to apply on their own name. That is the difference between marked applications and what? Firm underwriting. Now, we'll directly go to the problem with marked applications. Go to this. C Limited came out with an issue of 45 lakh equity shares of 10 each at a premium of 2 per share. Promoters took 20% of the issue. Balance was offered to the public, which means out of the 45 lakh shares, okay, how much promoters took? 20% means how much it will be? 9 lakhs, huh? Okay, so 45 lakhs minus 9 lakhs, balance, how much is issued to public? 36 lakhs is issued to the public. There is a firm underwriting of 1 lakh shares. Subscriptions, 31 lakh equity shares. Okay, with marked applications. A, B, C, the marked applications are given. 28,75,000. This is marked applications are given. Which means this 31 lakhs includes only what? Marked applications. Commission is 5% on the face value of shares. Those and all we will do it later. Now, if we will come to the solution, if you analyze, total issued 45 lakhs, less promoters. Promoters are taking 20%, which means 9 lakhs issued to public. 36 lakhs issued to public, 36 lakhs. Okay. Now, this is issued to public. Who are the underwriters? ABC. Let us keep it as ABC. If you look at what is the total received, what is the total amount received? Total applications received, 31 lakh applications received. This includes only marked forms. This includes only marked form, that is 28,75,000. Balance will be unmarked. Balance will be unmarked. Out of 31 lakh, 28,75,000 is marked forms. What is unmarked forms? Two lakh 25,000 is unmarked forms. Now to treat it. Simple. Gross liability. What is the ratio given? What is the ratio given? If no ratio is given, you can take equal ratio. 12 lakhs each. So totally 36 lakhs. Less marked forms. Marked forms first will be deducted. What is the marked form? 7,25,000. Then 8,40,000. Then 13,10,000. This is already given to us in the problem. Less firm underwriting. So why are you reducing firm underwriting? That is also will be treated like a marked application only. It is coming from underwriters, that will be treated like a marked application. At the end, we will add it back. Less unmarked forms. It will be distributed in 1:1:1 ratio. What is the unmarked form? 2,25,000. If we distribute it in 1:1:1 ratio, what is the amount? 75,000 each. So if you look at, you will get surplus or deficit in liability. So this 12 lakhs minus 7,25,000 marked forms minus firm underwriting minus unmarked forms, this will give us the liability. If you look at, there is a surplus in C's account. Surplus of C transferred to A and B. Surplus of C will be transferred to A and B. This will be plus 1,95,000. Firm underwriting is 1 lakh. Okay. So this is plus 2,85,000. This will be plus 2,85,000, and it will be transferred to the other underwriters in the equal ratio. In this problem, it is 1:1. So how much it will be? So after adjusting the surplus, what is the liability before firm underwriting? It is an internal adjustment. It will not come in the total column. It will not come in the total column. This will become 0. This will become 2 lakhs. Okay. So if you look at how many shares C is liable, 0. But apart from this, this is a liability before firm underwriting. Add firm underwriting. I can understand your mind voice. Or why are you reducing first? Again, why are you adding it? There is a reason. I'll explain. Wait. So this will be the final liability. This could be the final liability. Otherwise, let me to verify my answer. What is issued to public? 36 lakhs. What is received from public? 31 lakhs. So for how much underwriters are liable? 5 lakhs. How the liability will be? For the firm underwriting 3 lakhs, other liability 2 lakhs. So totally 5 lakhs of liability. Once again, let me to repeat. Gross liability, I hope you will not have a trouble in it. Okay. Let me to start or explain from the beginning. 45 lakhs shares are issued. Promoters took up 9 lakhs. Remaining is issued to the public. So we received 31 lakh application from public that includes marked forms and unmarked forms. Okay, gross liability is 1:1 ratio. Marked forms are actually deducted with the actual amounts. Firm underwriting is 1 lakh each. Unmarked forms are distributed in the equal ratio. We get a surplus of C that will be adjusted towards liability of other underwriters. If you look at liability before adding the firm underwriting, A 1,57,500, B 42,500, C is 0. Otherwise, if there was no firm underwriting, C would have been allotted no share. Okay, so underwriters are liable for firm shares. Underwriters are liable for the firm undertaking they have given. Firm means certain, sure. Okay, so 2,57,500. Okay, 1,42,500 and 1 lakh like that. Sir, what is the logic behind in reducing this first? Simple. We want to find out the real effort done by the underwriters and identify the surplus or deficit. Okay, if you look at C has done more effort. So that's why the firm underwriting is reduced. Sir, why are you adding the firm underwriting at the end? Why are you adding firm underwriting at the end? To ensure that they are also liable for firm underwriting. Otherwise, without firm underwriting, C would have got nothing. Because of the firm underwriting, he is getting what? 1 lakh. B, general liability is 42,500 after adjusting the surplus. Then is liable for firm shares 1 lakh. C, extra 1 lakh, like that. Okay, so we are reducing to calculate the real surplus, true surplus, the real effort done by the underwriters. And after adjusting the surplus, we are adding back the firm underwriting. We are adding back the firm underwriting to calculate the final liability of underwriters. To calculate what? Final liability of underwriters. That's the logic. Sir, can you do without reducing and adding? You can do, but answer will be wrong. Probably in this problem, it may not be wrong. Accidentally, you may get a correct answer, but in general, the problem or solution might be wrong. Now, sir, how to calculate the amount receivable for the shares? Underwriters have to pay. Underwriters have to pay. How much they have to pay? 2,57,500 into 12 rupees. Sir, how 12 rupees are? Face value is 10, it is issued at a premium of 2. So you are an underwriter, you have to pay me the money, the company the money, 2,57,500 into 2. This is the money receivable from the underwriter. This is the amount receivable from underwriter. Okay. Commission. Commission payable to underwriters. Commission will be calculated based on the gross liability. It's given in the problem. 5% of total price or face value. Face value. 5% on the face value of shares. Which means for A, this 12 lakhs into face value 10 into 5%. Okay. Gross liability into the face value into 5%. We get 6 lakhs. I hope that is going to be same. So this is a final amount. Net amount receivable from underwriters. So 30,90,000 underwriters out to pay, minus the company has to pay 6 lakhs. So 24,90,000 you will receive from A, like that for B and C and total. So in the examination, they can ask you this question. Question number 1 will be, what is the final liability of underwriters? Second is, what is the commission payable? Third question can be, what is the final amount receivable? What is the final amount receivable, like that? Okay, so 3 questions probably into 2 marks, 6 marks it can be tested. Once again, 45 lakhs minus promoters taking up 9 lakhs, so 36 lakhs issued to public. Total received is 31 lakhs, minus marked forms, received is 31 lakhs, minus marked form 28 lakhs 75,000, balance is unmarked, balance is unmarked. So gross liability, marked forms are directly deducted from underwriter's liability. Why? That is coming through your effort. Firm underwriting also, if nothing is specified in the problem, deducted directly from underwriters. Unmarked applications are distributed in the ratio 1:1:1. We get a surplus of C that is transferred to the other underwriters. Liability before firm underwriting is this much. Add firm underwriting because they are undertaking additionally 1 lakh shares. They are undertaking additionally 1 lakh shares. So this is a final liability. This is in shares. This is in shares. So for the underwriters, they have to pay. They have to pay for the shares, which means the final liability into 12 rupees. 12 rupees they have to pay. And the company has to pay underwriting commission. Sir, how much? Gross liability into 10%. Gross liability, 12 lakh shares into 10 rupees into 5%. Sorry, into 5% commission. So this is a net amount receivable from the underwriters. Because underwriters have to pay more money for the shares and we have to pay the commission. This is a net amount receivable or receivable from the underwriters. Yeah, this model question can be asked. And please remember, this case 1 and case 2 are important. Anyhow, I'm going to share the working and other things. You can go through that. The case 2 is most important case for examination. It's a partial underwriting, most important case. You can go through once again. Commission is always calculated based on the number of shares issued. This is the shares issued to public. Okay. Or you can do 36 lakhs into 10 into 5%. You will get 42 lakhs. Sorry, you will get 18 lakhs. You will get 18 lakhs. You can transfer in the ratio 1:1:1 ratio. Always commission is calculated on the value of shares issued. Gross liability. Look at question number 5. Okay. So everything if I do, I keep on talking, then it will be a boring one. Why can't you try this? I will give you 5 minutes of time. Try to work out this. Here also, total applications received, excluding firm underwriting, but including marked applications are given 22,500. Underwritten contract provides that credit for unmarked application will be given. Yeah, that will be in the ratio of shares underwritten. And giving the firm underwriting benefit to all underwriters means it will be treated like a marked application. It will be treated like a marked application. Try this problem. It is similar to the last one. Try to work out these 3 things. Final liability, then commission, of course, net amount receivable from underwriters. Try to work out. It's a simple and straightforward problem.
Sir, one doubt, sir.
Please ask.
Sir, underwriting commission, we have to calculate the premium amount also, right, sir? In institute material,
Since it is mentioned, 5% on the face value of shares. Since it is mentioned, I take only 10. Suppose if they just mention 5%, then I will take 10 plus 2, 12. Okay.
So any maximum percentage for this commission, sir?
5%. 5% for shares and 2.5% for debentures. Okay, try to work out question number 5. As I told you, I'll give you 5 minutes of time for solving this. 5 minutes of time for solving this. Okay, I will also work simultaneously along with you. What is the total received? What is the total received? Oh, sorry, directly they've given. Directly they've given. Unmarked application. This will be transferred in which ratio? 90,000, 32,500, 22,500. Can we make a ratio? Can we make a ratio? If we make a ratio, 12 is to 5 is to 3 ratio will come. Based on the number of shares, when you make out a ratio, it will come in 12 is to 5 is to 3 ratio. How much? We cannot do 1 is to 1 is to 1 ratio. Last problem, it was not mentioned, so we took 1 is to 1 is to 1 ratio. But in this problem, we know the number of shares unwritten, 90,000, 37,500, 22,500. We know the ratio of shares, 90, 32,500, 22,500. So how much it is?
Oh, apa? Oh, good.
This into how much? 20. Amount payable to underwriters. Marked application will be directly deducted. Marked application will be directly deducted. This into 5% of the issue price, not face value. 20 into 5%. This is the net amount receivable from underwriters. Yeah, the questions are how do you get this final liability? That is simple. The liability before form underwriting, add form underwriting, you get the final liability. Amount receivable will be 55,500 into 20. 55,500 into 20. Sir, how 20? Face value is 10, premium is 10. Issued at a premium of rupees 10 per share. Look at the problem. It is given issued at a premium of rupees 10 per share. Face value 10, premium 10, 20. Okay, sir. How this commission? Commission will be on 90,000 shares into 20 rupees into 5%. On the issue price, commission is given 5% on the issue price. 5% on the issue price. So this is the amount receivable from underwriters. Last problem, it was based on face value. Okay. All the problem will not be like that. So this is based on the issue price.
Sir, sorry to interrupt. There is a call.
There is a?
Shall I?
Yeah, please ask.
Sir, that unmarked application, we are split now, sir, equally to the underwriters now.
Not equally. In the proportion
Okay,
of shares
according to the
underwritten.
proportion. In this sum, according to the proportion, we are split. But here, sum, you said no, so one of the sum is important in objective characteristics being asked. In that, we are not splitted, sir. The 20,000 amount something the scheme, we are not splitted. The company has taken. We are arrived in the company.
Because it's a partial underwriting. It's a partial underwriting. 80% is only underwritten. 20% belongs to the company. So unmarked application received. Unmarked application received. The 20% part the company will take care. Because the company is liable for 20% of its own shares. For that 20,000 applications received, that will take it. Only the balance will be split between the underwriters in their ratio.
Okay, sir. So the case is a partial underwriting.
Yeah, that's a partial underwriting. It's a full underwriting case.
Okay, sir. Thank you, sir.
Yeah. If nothing is specified, commission will be calculated based on issue price. Here in this case, it is clearly mentioned. If they just tell you 5%, it will be on issue price. Last problem, it was clearly mentioned on the face value of shares. So depending upon the instruction given, you just go ahead. It is not always on the face value, not always on the issue price. It all depends on the exam question. If nothing is mentioned, it will be on the issue price, face value plus premium. Right? Next. Issue of shares for non-cash consideration. Okay, we'll see, go by example by example. This can be tested in the exam. A Limited issued 10,000 shares to promoters for their services. Face value rupees 10 and fair market value rupees 25 per share. Past journal entry. Okay, when shares are issued like this, shares are given to promoters for incorporating or for doing the services. What entry we'll pass? What entry we'll pass? When shares are given to promoters for the services rendered, it will be debited to goodwill account. Goodwill account data, this will be 10,000 shares into the fair market value, 25, 2,50,000. To share capital, 10,000 into 10, 1 lakh. To securities premium, excess, 1,50,000. Always face value will be credited. 10,000 into 10 will go to capital and 10,000 into 10, sorry, the excess amount, 15 will go to premium. So this we understood. Second, 12% debentures, rupees 5 lakhs, converted into equity shares. Face value rupees 10, fair market value rupees 25. Now debentures are going to be converted into shares. Debit the liability that is cancelled. Debentures account date are 5 lakhs. How many shares you will give for them? 5 lakhs divided by, will you put 50? 10, 25, which one you will take? 25. 5 lakh divided by 25, because for every one share, my market value is 25. I have to give you 5 lakhs. 5 lakhs by 25, how much you get? 20,000 shares I have to give you. So for converting to share capital will be 20,000 in shares into 10, 2 lakhs. Balance will go to securities premium. Balance will go to securities premium, 3 lakhs. Okay. A Limited purchased a plant and machinery for rupees 15 lakhs, payable in shares. Face value rupees 10, fair market value rupees 40. So how many shares you have to allot? 15 lakhs divided by 40. You have to give 37,500 shares. So what is entry we'll pass? First entry will be plant and machinery account debtor to vendor account. Vendor is nothing but seller account. For how much we purchased? 15 lakhs. Okay. For the vendor, we are giving equity shares. For the vendor, we are giving equity shares. Vendor may be B Limited or C Limited. Vendor account debtor to share capital to securities premium. 15 lakhs. Share capital will be 37,500 into 10. 3,75,000. Balance will go to premium. Excess amount will go to premium. Okay. Then number 4, bonus issue. Okay. Bonus issue we will learn along with redemption of preference shares. Buyback. Along with redemption of preference shares and buyback, we will learn. So these 3 cases can be tested in your MCQ. How much of capital is credited? How much of premium is credited? Like that, they can ask you questions. Or they can ask you how many shares are allotted for this, or how many shares are to be issued for this, like that. So one logical question, let me to give it. 15% debentures of rupees 100 each. Total rupees 80 lakhs. Were allotted 12% preference share capital of rupees 100 each without affecting their income. Pass journal entry. It's a tricky question. Try to work out. Debit, I will give you 15% debentures. Account debtor 80 lakhs. So how much will go to 12% preference share capital? And how much will be? How much will be securities premium? This question can be tested for about 3 marks in the exam. It is given without affecting their income. Without affecting their income. What is the income to debenture holders? Of course, interest. Interest will be 80 lakhs into 15%. 12 lakhs. So this income they should earn. This income they should earn. For this 12% preference shares are given. At 12% dividend, so how much they have to give? 12 lakhs you have to get. At 12% dividend means how much you have to get? 1 crore. Simple. What is your present income? Interest, 12 lakhs. The same income in future you are going to get in the form of dividend at 12%, which means I will give you 1 crore worth of preference share capital. So preference share capital will be 1 crore. Okay. Don't call this as discount and issue. This is called as loss due to conversion. This will be transferred to P&L account. This will be transferred to which account? P&L account. Excess amount paid, 20 lakhs, will be adjusted in profit and loss account. Don't call it as discount and issue. Once again, you are a debenture holder. What is your income now? 12 lakhs. In future, you are going to be a preference shareholder getting 12% dividend. So 12%, that is 12 lakhs, should be earned at 12% means what should be the face value of preference share I should give you? 1 crore. So old liability is 80 lakhs, for which I am exchanging with 1 crore of preference share capital. there is a loss, that loss will be adjusted in P&L account. This is not a company accounts based question, a logic based question. This can be tested for 2 marks in the exam. They can ask you question, what is the loss in conversion? Or they can ask you, what is the face value of preference share to be given? Done. With this redemption of, this one. No, we cannot issue shares at discount. In any circumstance, we cannot issue shares at a discount, okay? So underwriting is over with this. Okay. Or redemption of preference shares. Let us move on with redemption of preference shares. Okay. See, first company law rule that says is, let's assume preference share capital of 100 lakhs, you're repaying. Whatever is redeemed out of profit, redeemed out of profit, we have to transfer to CRR. A capital redemption reserve should be created. Let's assume out of profit, we are redeeming 60 lakhs, means create 60 lakhs of CRR. Create 60 lakhs of CRR. Balance, you will make a fresh issue. Okay, fresh issue may be 40 lakhs. Okay, suppose if they give you fresh issue, balance you take it as out of profit and create CRR. What is CRR? Capital redemption reserve. You would have learned already. It's a revision class again at a learning session. Okay, so the CRR can be utilized only for the purpose of bonus issue. It can be issued only for the purpose of which one? Bonus issue. So as per company law, only fully paid shares can be redeemed. Okay, the face value of shares redeemed out of profit should be transferred to CRR. Okay, what are the reserves we can transfer to CRR? What are the reserves available not for CRR? You can use general reserve. You can use profit and loss account. You can use reserve fund, contingency reserve, all revenue reserves. You can use it. Capital reserve, yeah, even sinking fund also you can use it. Not available for CRR, securities premium. Securities premium. CRR already available. Capital reserve. Share forfeiture account. Okay. Pre-incorporation profits. Revaluation profits. On asset revaluation, you may create that revaluation profit or revaluation surpluses. Then statutory reserves like gratuity fund or any other reserves has to be created as per law. Development reserve. These reserves are not available for CRR. These reserves are not available for CRR. These reserves are available for CRR. Okay. Now let me give a problem, or let us go to the problem. The question they can ask you, okay, let me go with example 1, then let us go to the problem. A Limited redeemed 15% preference share capital, rupees 10 lakhs at a premium of 20%. It has 30 lakhs in general reserve and 5 lakhs in profit and loss account. Rupees 2 lakhs in securities premium. Okay, probably I'll change this general reserve part alone. General reserve, let us not take it as 10 lakhs, let us take it as 4 lakhs. investments rupees 3 lakhs were sold for rupees 2,50,000 for the purpose of redemption. For the purpose of redemption. Bank balance before redemption rupees 2 lakhs. Bank balance before redemption rupees. Okay, let us keep it as 5 lakhs. Okay. Case 1. If 30,000 equity shares of rupees 10 each issued at 10% premium, calculate, they can ask you CRR, bank balance after redemption. Any one of the case will be tested in the exam for sure. This will be for 4 marks. This chapter is important for totally 6 marks. If this question is tested, case 1 is tested, it will be for 4 marks. What is the face value redeemed? What is the face value redeemed? 10 lakhs. What is the face value of fresh issue? What is the face value of fresh issue? 30,000 equity shares of 10 each means 3 lakhs. So balance is out of profit. And we need to create CRR for this. 10 lakhs minus 3 lakhs, how much? 7 lakhs. This balance is out of profit. It is redeemed. We have to create CRR. From where you will create CRR? From general reserve, we can take how much? 4 lakhs. From profit and loss account, we can take 5 lakhs. From general reserve, 4 lakhs, and from profit and loss account, 5 lakhs available, but we need how much? Only 3 more lakhs. Totally 7 lakhs we have to transfer. From general reserve, we can take 4 lakhs. Balance, we can take 3 lakhs from P&L account. And please remember, ignore premium for calculating. Okay. Premium means premium on issue as well as premium on redemption should be ignored for calculating CRR. Once again, I repeat. What is the face value redeemed? 10 lakhs. What is the face value of fresh issue? 3 lakhs. 30,000 shares into 10, 3 lakhs. So 7 lakhs is out of profit. You create CRR. From general reserve, we can take 4 lakhs. Balance, you can take it from P&L account. And please ignore premium, which may be premium on issue or premium on redemption. Case 2 is for you to work out. Easy cases I will solve. Tough cases I will expect you to work out. If a minimum balance. Okay, one more question. It is there. Calculate bank balance after redemption. What is the bank balance before redemption? What is the bank balance before redemption? 5 lakhs. Add sale of investments. How much you will take? 3 lakhs or 2,50,000? Good, 2,50,000. Add fresh issue. Fresh issue, 30,000 into 11. Only for CRR, we will not take premium, but money is collected, money will be added to bank. Less redemption. Redemption is 10 lakhs plus 20%. 12 lakhs we have to pay. So closing balance. It becomes negative. We won't believe our own answer. It becomes a bank overdraft. When bank balance is negative, that is bank overdraft. Okay. They will give you option. Answer A, plus 1,20,000. B, OD 1,20,000. C, 0. D, 40,000, like that. They may give you options. Okay. So case 1, if 30,000 equity shares are issued, 3 lakhs is the face value of fresh issue. Balance out of profit, 7 lakhs, we have to create CRR. From general reserve, 4 lakhs, and from profit and loss account, 3 lakhs. So for ignore premium for calculating CRR. Now the most important point. Okay, now let me add the next case. Case 2. A minimum balance of rupees 3 lakhs has to be maintained in profit and loss account. Sufficient number shares were issued, face value rupees 10, premium rupees 2.5. Calculate CRR, number of shares to be issued, bank balance after redemption. Same example, same base, we are just doing it again. See, bank balance has nothing to do with P&L account. Profit and loss account balance is based on liability reserves, okay? Bank balance is based on amount collected and paid. This has nothing to do with general reserve. This has nothing to do with P&L account. This has nothing to do with CRR. There is no connection between CRR, bank balance, general reserve, all those things. They are all reserves and surplus. Bank balance is based on only what is collected and paid. Now, for the second case, try to work out. In this case also, face value redeemed is 10 lakhs. Okay, from what is a CRR? Okay, let us work out this first. General reserve we can take full. There is no restriction in usage of general reserve in this problem. What is the general reserve amount that is given in the problem? 4 lakhs. P&L account, the amount given is 5 lakhs. Okay, we have to maintain a minimum balance of how much? 3 lakhs. We cannot take that. Apart from that, don't ignore this. Loss on sale of investment. Investments of 3 lakhs were sold for 2,50,000. There is a loss on sale of investment. So from P&L account, we can use only 1,50,000. So CRR, 5,50,000 is the amount available. Okay, once we know CRR amount available, we know the face value redeemed to 10 lakhs. CRR is 5,50,000, which means it's a reverse of last problem. Balance will be face value of fresh issue. That is 4,50,000. 4,50,000 divided by face value. Let us assume 10 rupees. Yeah, it is given 10 rupees per share. So it will be 45,000 shares. 45,000 shares we have to issue. Then bank balance is based on the same. Bank balance working will be same. Fresh issue will be how much? 45,000 shares into 12.5. 45,000 shares into 12.5. Others are same. See, for working out collection, should be based on the amount collected, 45,000 shares into 12.5 per share we collect. This calculation is same. This calculation is same. A minimum balance of 3 lakhs has to be maintained in P&L account. Okay. That's why we adjust this 3 lakhs and loss at sale of investment. 5,50,000 is the maximum CRR possible. So the balance will be the face value of fresh issue. Face value of fresh issue. So 4,50,000 divided by 10, 45,000 shares we need to issue. So bank OD is 1,12,500. No, this is a bank balance. We are going for case 3. We are going for case 3. If you're not copied, also no issues because I'm going to share this working. Case 3. Same thing, a minimum balance of 3 lakhs. Probably let me change the amount, that's better. Minimum balance of 2 lakhs has to be maintained in bank. Sufficient number of equity shares are issued. Everything is same. Only thing is that minimum balance of 2 lakhs has to be maintained in bank. Why do we divide with face value? This is total 4,50,000 is face value. I told you to ignore premium for calculating CRR, okay? So this is the face CRR available. This is the face value of fresh issue. So per share, 10 rupees face value. So 45,000 shares of 10 will give us 4,50,000 face value. Ignore premium, please. Ignore premium, please. Now we want to maintain a minimum cash balance of 2 lakhs in bank, or we want to maintain a bank balance of rupees 2 lakhs. For this, we want to issue sufficient number of equity shares. Work out, the questions are work out number of shares. They cannot ask you, or they can ask you this, cash shortage. Number of shares to be issued, then CRR. We'll see. Same working. We don't have a fresh issue. Bank balance before redemption is 5 lakhs. We sold investments for 2,50,000, less minimum balance. Minimum balance required after redemption. How much is required? 2 lakhs required. So cash shortage, 6,50,000. Okay, we have got 5 lakhs in the bank account. Sale of investment we have done for 2,50,000. That is an inflow. We need to maintain 2 lakhs minimum balance, and we have to pay 12 lakhs to the debenture service preference shareholders. There's a cash shortage of 6,50,000. There's a cash shortage of 6,50,000. Number of shares to be issued will be 6,50,000 divided by 10 or 12.5. See, there we have taken 10 because it was based on CRR. This is based on the cash shortage. See, you want 6,50,000 per share. How much of cash you will collect? 12.5. 52,000 shares. 52,000 shares we need to issue. So cash shortage is 6,50,000. Number of shares to be issued. Once again, I repeat. Bank balance available is 5 lakhs plus you sold investment for 2 lakh 15. Okay, we want 2 lakhs of minimum balance after redemption, and for redemption we want 12 lakhs. There is a cash shortage of 6 lakhs 50. 6 lakhs 50,000 divided by 12.5. Why 12.5? Think logically. We want cash 6 lakhs 50,000. For every one share you are collecting face value plus premium. So 52,000 shares you have to issue. CRR calculation is going to be entirely different. That is not connected with all these things. What is the face value redeemed? What is the face value redeemed? 10 lakhs. What is the face value of fresh issue? 52,000 shares into 10. 5,20,000 is a fresh issue. So balance you have to create CRR. How much of CRR? 4,80,000 you have to create CRR. So from where general reserve we can take 4 lakhs, P&L account balance you can take 80,000. From this you can understand there is no connection between the CRR working. There is no connection between the CRR working and the cash shortage. CRR is only because of company law rule. CRR is only because of company law regulation that we do it. Okay, 10 lakhs minus face value of fresh issue, we create CRR. So in these three cases, any one can be tested in exam. Any one can be tested in exam. So understand the difference. First case, they have given number of shares itself. We work out CRR directly and bank balance after that. Second case, number of shares are not given. Minimum balance is based on P&L account. So we worked out CRR. Based on that, we decided how many shares are to be issued. Now, minimum bank balance has to be maintained. Minimum bank balance has to be maintained. So we work out cash shortage. Then we work out number of shares. Thereafter, we come to CRR. This case 3 is important. This can be tested for 6 marks. For each question, this 2 marks, number of shares 2 marks, and this CRR 4,80,000, they can ask 2 marks like that. 6 marks question can be tested in exam. Again and again, I have to give a disclaimer. This is applicable only for online examination and not for June 2021 examination. If any student is sitting there or any student is watching this video, by any chance, if you are writing in June 2021, you will certainly will not pass. This is only for December 2020 examination. Disclaimer. Done? We will proceed to the material question. Why number of shares? I told you already, you want 6,50,000. Okay. Per share, you are collecting 12.5. So you have to give 52,000 shares. You have to issue 52,000 shares. For calculating company law purpose or legal purpose, only the face value need to be considered. This is a capital redeemed. This is a capital raised. This is also capital. This is also capital. They are not asking you to take overdraft. Cash shortage, they are not asking you to take overdraft. They are asking you to issue fresh shares. A minimum balance of 2 lakhs has to be maintained and sufficient number of shares were issued, which means don't take OD. When they ask you to issue shares, I will take OD. Okay, that's not good, you know. Now come back to this question. Balance sheet abstracts are given. Preference share capital, equity share capital, debentures, revenue reserves, total represented in net assets. Okay. Redeemable preference shares due on redemption on 31st August 2017. Okay. And were redeemed and duly paid off. The company permitted to redeem debentures at any time at a premium of 10% and did so on 30th September 2017. Okay. The company reasonably in liquid position, but to assist providing funds for redemption of preference share. A right issue means a fresh issue. 20,000 equity shares were issued at a premium of 20 per share. 12.5 payable and along with application. balance and allotment. Okay, that and all doesn't matter for us. All cash due were collected. Okay. Now they can ask you, based on this question, they cannot ask a journal entry in the exam. This is for question number 6. Redemption of preference shares. Okay. What is the face value redeemed? What is the face value redeemed? 10 lakhs. What is the fresh issue made? You should take only the face value. 20,000 equity shares at a premium of 20 and all doesn't matter. 20,000 equity shares, face value is 10 rupees. Face value is 10 rupees. 2 lakhs. Balance we have to create CRR. Ignore premium. CRR need to be created for 8 lakhs out of the revenue reserves. Okay, so 10 lakhs is a face value redeemed. 2 lakhs is a face value of fresh issue. This is out of profit. This 8 lakhs is out of profit. You create CRR from revenue reserves. They can ask you bank balance after the above transactions. Here a little, you have to be little careful. 1 minute. Okay, coming back. See, debentures are redeemable on 31st August. They're redeeming 1 month later. They're redeeming 1 month later. For this, extra amount will not be paid. You will get the same amount. You will get the same amount. Of course, the premium 10%. But debentures, we have to be very careful. Debentures, we have to be very careful. The balance sheet is given on 30th June 2017. Debentures were paid on 30th September 2017. Debentures are like loans. Okay, before that. Okay, bank balance we cannot work out also because we are not given any bank balance before. So ignore this. So based on this question, only one question can be tested. What is CRR? What is CRR only can be tested. They cannot ask a bank balance. They can ask you what is amount payable to debenture holders. They can ask this maximum. What is the face value of debentures? What is the face value of debentures? 15 lakhs. Then we are redeeming at a premium of 10%. Premium 10%. Not only this, balance sheet is given on 30th June 2017 and debentures are paid on what date? 30th September 2017. How many months? 30th June 2017 to 30th September 2017. How many months? 3 months. Interest has to be paid. Debentures are like loans. You have to pay interest. So 15 lakhs into what is the debenture percentage interest? 12% debentures. Oh, aha. This is not 15 lakhs. This is 7 lakhs. Sorry. 7 lakhs. This is 70,000. This is 7 lakhs into how much percentage debentures? 12% for 3 months. How much it comes? So this is the total amount payable. This is the total amount payable to debenture holders, including interest. They can ask this as an MCQ. because journal entry is not possible now, they can ask you how much is the amount payable to debenture holders and what is the CRR to be created. They can ask about this in case of redemption of preference shares. Done? Go to question number 7. We are not bothered about authorized capital. Please ignore information about which one? Authorized capital, don't bother about it. Issued and subscribed capital, 20,000. Preference shares of 10 each, 2 lakhs. 20,000 equity shares of 2 lakhs. We are given general reserve securities premium P&L account and current liability. Then we are given debentures and other things. The company made a net profit of 30,000 after providing 40,000 depreciation and writing of miscellaneous expenditure 40,000. The following is the additional information available. Okay. Preference shares are redeemed. Okay. Preference dividend for the year ended was paid before 31st March 2017. Except cash and bank balance, other current assets and current liabilities were same. The company redeemed preference shares at a premium of 10%. The company issued bonus share 1 for every 2 shares held on 31st March 2017. To meet the cash requirement, the company sold a portion of investment and leave a minimum balance of how much? 60,000 after redemption. Then investments were sold at 90% of cost. Investment were sold at 90% of cost. Here they can ask you, they can ask you, okay, what is the preference share? What is the CRR you have to create? What is the CRR you have to create? Okay. For this, we need to work out, cash and bank balance. If you look at balance sheet is given on 31st March 2016. Balance sheet is given on 31st March 2016. Okay. But redemption takes place after 1 year. Redemption takes place after 1 year. Okay. So we need to work out what is the cash balance. What is the cash balance on this date? This cash balance is at the beginning of the year. Do you remember in financial management, for solving this, we require financial management knowledge. Okay. Bank balance on 31st March 2016. What is the bank balance on 31st March 2016? 1 lakh. Right? We need bank balance on 31st March 2017 before redemption. Then we have to adjust for redemption, all those things. How to work out? Any idea? Do you remember how to calculate cash flow? We used to take EBIT, or we used to take earnings before depreciation and tax, then less depreciation, less tax, then add back depreciation and amortization. We will get cash inflow. Do you remember? In capital budgeting, you would have done this. Earnings before depreciation and taxes, less depreciation and less tax will give us earnings after tax. Okay, this will give us earnings before tax. Earnings before tax, less tax will give us earnings after tax. Add back depreciation and amortization. Earnings before depreciation and tax minus depreciation will give us EBT, minus tax will give us EAT. Add back depreciation and amortization, because there is no cash outflow for this. This will give us net cash inflow. Okay, if we apply this, what is the profit after tax given to us in the problem? What is the profit after tax given in the problem? 30,000. Add back depreciation because there is no cash outflow for this. Add back amortization. Amortization means miscellaneous expenditures and intangible assets written off. 40,000. So cash inflow from operations would have been how much? 1,10,000. This is the net cash inflow from operation. So the closing balance would have been 2,10,000. The closing balance would have been 2,10,000. It is clearly mentioned in the problem. It is clearly mentioned in the problem. The company made a net profit after providing 40,000 depreciation. The following information is available. Okay, and they have paid preference dividend also. The audio is clear or not? Is the audio clear from my end? It's clear. Okay, less we have paid preference dividend also. We have paid dividend on preference shares. How much dividend we paid? We need to work out. 2 lakhs into 10%. 2 lakhs into 10% we paid. That comes to 20,000. So the balance would have been 1,90,000. Once again, I repeat from the beginning, please understand. Last year balance was 1 lakh. Profit after tax, add depreciation and add amortization. Why? Because they are non-cash items. It will give us cash inflow from operation. We have paid dividend on preference shares. It's given in the problem that dividend was paid. Dividend was paid. Except cash and bank balance, current asset and current liabilities are same like that. It is given to us. Okay. So 20,000 redemption of preference shares. Sorry, dividend on preference shares. We have done 20,000. So bank balance before redemption would have been 1,90,000. Okay. After this, we sold investments. Investments for 90% of the balance. Look at the balance sheet amount. What is the investment value given? 2 lakhs into 90%. 2 lakhs into 90%. We sold for how much? 1,80,000. So total cash available is 1,90,000 plus we sold investments now for 1,80,000. 3,70,000 is the total cash available. Okay. Less. It is asked to maintain. What is asked to maintain? A minimum bank balance is asked to be maintained. Check. That the minimum balance to be maintained.
Investments yes. Minimum balance 60,000.
That's what. That's what. Less minimum balance. Minimum balance to be maintained is 60,000. Minimum balance to be maintained is how much? 60,000. Less money required for redemption. What is the preference shares? Preference shares are redeemed at a premium of 10%. So we need 2 lakhs plus 10%. We need 2 lakhs plus 10%. How much we need? 2,20,000 we need. This will give us cash shortage. 3,70,000 available minus 60,000 minus 2,20,000. 90,000 is a cash shortage. Once again, I repeat. I hope bank balance, opening balance is given in the problem. Profit after tax, add back non-cash items, you will get cash flow from operations. Minus dividend on preference shares will give us bank balance before redemption. We sold investments, there is an inflow. We need a minimum balance and money required for redemption. There is a cash shortage of how much? 90,000 or there is a surplus. Investments, where is the investment? 2 lakhs into 90%, 1,80,000 we sold. Yeah, everything is correct. There is no fresh issue required. Okay. Here there is a highlight. Read the point number E. Read the point number E carefully. To meet out the cash requirement, the company sold not all the investments. The company sold Not all the investments. Read this. Sold a portion of investment. Sold a portion of investment only. Only a portion of investment has been sold. So it is not entire investments are sold. Okay. So we need to maintain, okay, now entire working has to be reversed. Entire working has to be reversed. Okay. Less minimum balance to be maintained. How much you have to maintain? 60,000. But less, what is the cash required for redemption? 2 lakhs plus 20,000, 2,20,000. Now you work out what is the cash shortage. What is a cash shortage? For this, we are selling investments. This is a shortfall in cash. Shortfall in cash. For this, we are selling investment. For this, we are selling what? Investment. What is the total investment in the balance sheet? 2 lakhs. This is cost. Okay, we are selling investment for 90,000. Simple. 90,000 should be the selling price. That is 90%. Therefore, what is the cost of investment sold? What is the cost of investment sold? If 90,000 is 90%, what is the cost of investment sold? Simple. 90,000 divided by 90%, you will get 1 lakh. This is the cost of investment sold. Otherwise, cost of investment sold is 1 lakh for 90,000. That is 90%. Therefore, loss on sale of investment 90,000. Loss on sale of investment 90,000. Sorry, 10,000. Loss on sale of investment is how much? 10,000. Here, most important, this is not required. How much of CRR you will create in this problem? How much of CRR you will create in this problem? Once again, repeat. 1,90,000 is available. We have to maintain 60 and we need 2,20,000. That's a shortfall of 90,000 in cash. Okay, for this, we are selling investments at 90%. If 90,000 is 90%, cost of investment would have been 1 lakh. So 1 lakh minus 90,000, there is a loss of 10,000. How much of CRR in this problem? So this question, if it is tested in the exam, they will ask you what is the shortage of cash, what is the face value of investment sold, what is the loss on sale of investment and all. CRR, face value of preference shares redeemed. How much? 2 lakhs. Is there a fresh issue? Is there a fresh issue? Nil, no fresh issue. We have not issued any fresh shares. So CRR should be 2 lakhs. Only the face value of preference shares redeemed should be transferred to CRR. From where we can take this? We can take it from P&L account, general reserve. We have got general reserve itself. From general reserve we can take. From general reserve we can take for CRR. Once again, what is the face value of preference shares redeemed? 2 lakhs. Did we make any fresh issue? No. So you have to create 2 lakhs of CRR. You have to create what? 2 lakhs of CRR from where? From general reserve. This apart, there is one more thing. There is one more thing in the problem. There is a bonus issue. There is a bonus issue of 1 share for every 2 equity shares held. Okay. So look at equity shares. How many equity shares are there? 20,000 equity shares are there. So bonus issue will be 20,000 equity shares into 1 by 2. That is 10,000 equity shares.
Sir, நம்ம 20,000 வந்து preference dividend pay பண்ற மாதிரி இருக்கு. Sir, last year
That we have adjusted here. That's what. We paid a preference dividend that we have adjusted here. Cash balance slightly adjusted. Okay. We need to make a bonus issue of 10,000 equity shares, which means 10,000 equity shares at the rate of 10. It will make 1 lakh rupees. From where the bonus issue will be made? From CRR. Bonus issue is made from what? CRR. So in the examination, if they ask a question like this, they can ask you what is a cash shortage and what is the loss on sale of investment, how much is the CRR, and what is the value of bonus share issued. They can ask 4 questions. Of course, for 7 to 8 marks, I can test this in the exam. Now we understood for bonus issue, let us learn a journal entry. For bonus issue, 2 journal entries we used to pass. First journal entries are what happens in the process of bonus issues. What happens in the process of bonus issues? Resource become capital. Resource become what? Capital. No money will come in, no money will go out of the company. Okay. The first reserve that we will take it CRR account data. CRR account data are other free reserves. Account data to bonus for equity shareholders. If CRR is not available, you can take it from what? Other free reserves to bonus for equity shareholders. Then bonus for equity shareholders account data to equity share capital. See, there are certain reserves not available for bonus issue. One is revaluation reserve, because it's a non-cash reserve. Okay, then if there is any capital reserve, if not realized in cash, then securities premium, not realized in cash. For example, we have issued shares for purchasing asset. We've issued shares for purchasing asset. To that extent, we would not have received the cash. So whatever is the reserve that is not realized in cash, that cannot be taken for bonus issue. That cannot be taken for bonus issue. Okay. Sir, what is the purpose of bonus issue? To improve the liquidity in the market, to improve the liquidity of tradability of shares in the market. Yeah, statutory reserves cannot be taken. Yeah, statutory reserve cannot be taken for bonus issue. Okay, so because of bonus issue, whether there will be a change in the capital structure? No, your capital will not go up or it will not come down. It will be the same. Come to the next problem. Let us see. Question number 8. We've got preference shares, we've got equity shares, that is authorized capital, doesn't matter for us. 12% preference shares, 48 lakhs, 5,40,000 equity shares, 8 rupees paid up. Partly paid up shares are there, okay. General reserve is there, CRR is there, securities premium collected in cash is given, P&L account balance is given to us. They made a final call of 5,40,000 shares of rupees 2 each. So they are making it fully paid up. Now share capital will be 5,40,000 equity shares. Already 8 rupees paid up, plus now collected 2 rupees. So totally it will be 10 rupees. So it will be like 54 lakhs. Okay, 54 lakhs. The company decided to capitalize the reserves by way of bonus issue in the ratio of 1 for every bonus 4 shares held. So bonus issue will be 5,40,000 into 1 by 4. One lakh 35,000 shares we have to issue. So value will be 1,35,000 into 10. 13,50,000. Sir, from where the bonus issue will be made? We already know. From CRR. What is the CRR available for this? 2,40,000 we can take. Securities premium. We can take it as realized in cash, we can take it. Always take the P&L account at the end because it can be used at the end. It can be used for many purposes. From general reserve, we can take 7,20,000. Balance from profit and loss account. We need 13,50,000. We have taken from CRR 2,40,000. From premium 1,50,000. From general reserve, we have taken this much. So balance from P&L account, we will take 2,40,000. Okay. So from P&L account, we take 2,40,000 for bonus issue. Done. So wait a minute. Yeah, any mistake I've done here, Prasad?
Sir, investments.
Okay. Investments we calculate as a shortfall. Investment we work out as a balancing figure. Shortfall in cash, for that we are selling investment. We are not going to issue fresh shares for this. For the shortfall, we are going to sell the investment. All investments are not sold. We are selling only the required investments. It is clearly given the problem. Only a portion of investment has been sold. So 1,90,000 is available. Minimum balance minus cash required for redemption. Shortfall in cash is 90,000. For this, we are selling investment, which means 1 lakh worth of investments we are selling. Costing investments we are selling, not all the investments. So bonus issue from CRR 2,40,000, from securities premium 1,50,000, from general reserve 7,20,000. Balance you can take it from P&L account. If you want to pass the journal entry, it will be like CRR account data 2,40,000, securities premium 1,50,000, general reserve 7,20,000, then P&L account 2,40,000 to bonus for equity shareholders. So bonus issue may be tested for 1 mark. So from whatever we had seen, issue of shares can be tested for 6 to 8 marks. Okay. For underwriting again, maximum 6 marks or average 6 marks that was tested. Redemption of preference shares, that is tested for about 5 marks in the exam. Buyback, okay. Buyback that we are going to see for another 5 marks that can be tested. Okay, so 1 minute. Okay, let me to stop here. Tomorrow morning, buyback we will see. For buyback we will see then debentures, then final accounts. This is for tomorrow morning session. Buyback, it will take about 1 or 30 minutes time. Debentures, it will take about 30 minutes time again. Final accounts will take about 1 hour time. So what I'm requesting is, please go through the format of P&L account and the balance sheet today. Okay, go to the format of P&L account and balance sheet today. before listening or to the next lecture, next revision lecture. These things are for tomorrow morning session. These things are for tomorrow morning session. Evening session, we'll do cash flow statement. Evening session, we'll do cash flow statement. Okay, ensure that you're revising cash flow statement and come to the problem. Okay, our evening session tomorrow. Okay, that is for tomorrow. Then day after tomorrow, we'll be doing morning session, bank, insurance, electricity company accounts. Then evening session, we'll be doing accounting standard. Tomorrow morning, we'll start by 6. I'll start by 6. These 3 chapters, because these 3 chapters require a fresh mind. Okay, so from my end also, it requires a fresh mind. So we'll start tomorrow morning, 6 o'clock.